we are going to walk through short exercise 13-7. In 13-7, we're given an income statement, and we're going to use the balance sheet that was given in short exercise 13-6 to compute the following. A, their rate of inventory turnover in days inventory outstanding. B, days sales in average receivables. C, accounts payable turnover in days payable outstanding. And finally, D, length of cash conversion cycle in days. So we're going to get started. This is just applying the equations to each one of these. The inventory turnover ratio is calculated as cost of goods sold divided by average inventory. So when we do that, we're going to take cost of goods sold of $2,639, and we are going to divide by average inventory. Now, something to note here with average inventory, we're going to take 2014 end of year plus 2013 end of year, add those together and divide by 2. That gives us the average inventory, and it's very important that we use average inventory. When it says average inventory, you take the current year end, the prior year end, divide by 2, and that gives us the average inventory. So inventory turnover then is going to be 29.7 times. So this inventory for this company turned over 29.7 times during 2014. Next up, we want the days inventory outstanding for 2014, and the formula is given there on the page. We're going to be taking 365 divided by the inventory turnover figure that we just got. So this number here that we just had, the 29.7 times, well, that's what we're going to use in this formula here. We'll take the 365, divide by that inventory turnover. So what we get looks like this. 365 divided by the 29.7 gives us 12 days. So on average, it takes us 12 days to sell inventory. So that was part A. Now we move on to B. B asks us to compute the days sales and average receivables during 2014. So first thing we need to do is calculate 1 day's sales. So we're going to take our annual sales, divide by 365. Once we get that number, we'll be able to take that into our average net receivables, divide by 1 day's sales to get the days sales outstanding. So here, let's put some numbers in there. 1 day's sales is going to be our sales revenues divided by 365 gives us 27. And then we go on to do the bottom, and we're going to get our average net receivables divided by the 27.0. Now our average net receivables, we've got to do a little work for that one. Again, we've got the word average here. So what we have to do is we have to take the end of 2014, add the end of 2013 balance, add those together, divide by 2. That'll give us average inventory. So that's where we're getting that. So we end up with days sales outstanding of 9 days. And that's it for part B. So now we go on to part C. Part C says calculate accounts payable turnover in days payable outstanding. So what we're going to do here is we're going to take accounts payable turnover, which is cost of goods sold divided by average accounts payable, and then we'll get our days payable outstanding by taking 365 divided by accounts payable turnover. Let's tackle accounts payable turnover first. We're going to take cost of goods sold from the income statement. Then we need to get the average accounts payable, and just like before, to get the average we need to take this year end plus last year end and divide by 2. So what you're seeing there is the 1,000 accounts payable from this year, 900 last year, divide by 2. So we end up with 2.8 times as our accounts payable turnover. Then moving down to the days payable outstanding, 365 divided by that 2.8 times. Then what we're going to get is 130 days. Okay. Next up, part D. Part D, length of cash conversion cycle. We will take our we'll go back to I'll show you the DIO plus the DSPO and the DPO. So that's a lot of acronyms. So let's go back to A, days inventory outstanding, DIO, was 12 days. And then in part B, let's see where we got to part B, DSO, days sales outstanding, was 9 days. And then part C, when we ended up with part C, we had days payable outstanding of 130 days. So what we get with this one then is we're going to get this minus 109, and that probably isn't the best example, but that is numbers that were given in your book. So that's how you get the cash conversion cycle. Okay, so that's it for short exercise 13-7.